Whether you're just starting your investment journey or you've been at it for a while and want to refine your strategy, this video is going to give you a comprehensive roadmap. We're going to cover what diversification actually means, why it matters so much, the different asset classes you should consider, how to allocate your money based on your goals, and some common mistakes that trip people up along the way. Before we jump in, I want to be clear that this is educational content, not personalized financial advice. Everyone's situation is different, so consider speaking with a qualified financial advisor before making major investment decisions. All right, let's get into it. So first things first, what exactly is diversification? In simple terms, diversification means spreading your investments across different types of assets, industries, and geographic regions so that you're not putting all your eggs in one basket. Here is why this matters. Imagine you invested your entire savings into a single company's stock. If that company does well, fantastic, you're making money. But if that company hits hard times, goes bankrupt, or even just has a bad quarter, your entire financial future takes a massive hit. That is an enormous amount of risk concentrated in one place. Diversification helps manage that risk. When you spread your money across many different investments, the poor performance of one can be offset by the strong performance of others. It smooths out the ride. You might not hit the absolute highest highs, but you also protect yourself from the devastating lows. Now here is the key insight that a lot of people miss. Diversification isn't just about owning lots of different stocks. True diversification means owning assets that behave differently from each other under various economic conditions. Some assets go up when the economy is booming. Others hold steady or even increase in value during downturns. By combining these different types of assets strategically, you build a portfolio that can weather multiple types of storms. Let's talk about the main building blocks you'll use to construct your diversified portfolio. These are your core asset classes. Stocks or equities. Stocks represent ownership in companies. When you buy a share of stock, you own a tiny piece of that business. Historically, stocks have provided the highest long-term returns of any major asset class, averaging somewhere around 7 to 10% annually after inflation over very long periods. However, they also come with significant volatility. Stock prices can swing wildly in the short term. Within stocks, you can diversify further by company size: large cap, mid cap, small cap; by sector: technology, healthcare, energy, consumer goods; by geography: domestic versus international, developed markets versus emerging markets; and by investment style: growth stocks versus value stocks. Bonds or fixed income. Bonds are essentially loans you make to governments or corporations. In exchange, they pay you interest over time and return your principal at maturity. Bonds are generally considered safer than stocks, but offer lower returns. They serve as a stabilizing force in your portfolio, often moving in the opposite direction of stocks during market stress. You can diversify your bond holdings by duration: short-term, intermediate, long-term; by credit quality: government bonds, investment-grade corporate bonds, high-yield bonds; and by geography. Real estate. Real estate can be a powerful addition to a diversified portfolio. You can invest directly by purchasing property or indirectly through real estate investment trusts, known as REITs, which trade like stocks but own portfolios of properties. Real estate often provides both income through rent or dividends and potential appreciation over time. It also tends to have a low correlation with stocks and bonds, meaning it doesn't always move in the same direction. Commodities. Commodities include things like gold, silver, oil, agricultural products, and other raw materials. These can serve as a hedge against inflation and provide diversification benefits because their prices are driven by different factors than stocks and bonds. Gold, in particular, is often viewed as a safe haven during times of economic uncertainty. Cash and cash equivalents. This includes savings accounts, money market funds, and short-term treasury bills. Cash doesn't offer much growth, but it provides stability and liquidity. Having some cash in your portfolio means you have funds available for emergencies or to take advantage of investment opportunities when markets drop. Now that you understand the building blocks, the next question is how much should you put in each category? This is called asset allocation, and it is actually more important than picking individual investments. Studies have shown that asset allocation accounts for the vast majority of a portfolio's performance over time. Your ideal allocation depends on several factors: your time horizon, how long until you need the money. If you're investing for retirement 30 years away, you can afford to take more risk because you have time to recover from downturns. A longer time horizon generally means you can allocate more to stocks for growth. If you need the money in 5 years for a house down payment, you'll want a more conservative mix with more bonds and cash. Your risk tolerance, this is about your psychological comfort with volatility. Some people can watch their portfolio drop 30% and stay calm, knowing it is a normal part of investing. Others panic and sell at the worst possible time. Be honest with yourself here. The best portfolio is one you can actually stick with through thick and thin. Your financial goals, what are you investing for? Retirement, a child's education, building generational wealth. Your specific goals will influence how much risk is appropriate and what kind of returns you need to achieve. A common starting point that many people use is the rule of thumb, where you subtract your age from 100 or 110 to get your stock allocation percentage. So a 30-year-old might have 70 to 80% in stocks and the rest in bonds and other assets. A 60-year-old might have 40 to 50% in stocks. This is a rough guideline. Not a hard rule, but it illustrates how your allocation should generally become more conservative as you approach the time when you'll need the money. For a growth-oriented portfolio, you might consider something like 60 to 80% stocks, diversified across domestic, international, and emerging markets, 10 to 25% bonds, 5 to 10% real estate, and a small allocation to commodities and cash. All right, let us get practical. How do you actually build this portfolio? The easiest approach for most people is using low-cost index funds or exchange-traded funds, also called ETFs. These are funds that hold hundreds or thousands of individual securities, giving you instant diversification. Instead of trying to pick winning stocks, you simply buy funds that track broad market indexes. For example, a total stock market index fund gives you exposure to thousands of companies in a single investment. An international stock fund adds geographic diversification. A total bond market fund covers the fixed income side. A REIT ETF handles real estate exposure. The beauty of this approach is its simplicity and low cost. You can build a well-diversified portfolio with just 3 to 5 funds. Look for funds with low expense ratios, ideally under 0.2%, because fees compound over time and eat into your returns. If you want even more simplicity, consider target date funds. These are all-in-one funds that automatically adjust their asset allocation as you approach a target retirement year. You pick the fund with the year closest to when you plan to retire, invest your money, and the fund gradually shifts from aggressive to conservative over time. It is diversification on autopilot. Once you've set up your portfolio, the work isn't quite done. Over time, different assets will grow at different rates, and your allocation will drift from your target. Maybe stocks have a great year and suddenly they're 85% of your portfolio instead of 75%. This increases your risk beyond what you intended. Rebalancing means periodically adjusting your holdings back to your target allocation. You do this by selling some of what has grown and buying more of what has lagged. It sounds counterintuitive to sell your winners, but this discipline forces you to buy low and sell high systematically. Most experts recommend rebalancing once or twice a year, or whenever your allocation drifts more than 5 percentage points from your target. Many brokerage platforms offer automatic rebalancing features that handle this for you. Before we wrap up, let me share some common mistakes that can derail your diversification strategy over-diversification. Yes, this is a real thing. Owning 50 different funds that all basically hold the same stocks doesn't add diversification. It just adds complexity and potentially higher fees. Keep it simple and purposeful. Home country bias. Many investors put nearly all their money in their home country's market. The U.S. is a great market, but it is still just one country. International diversification can reduce risk and potentially boost returns over the long run. Chasing performance, it is tempting to pile into whatever asset class or sector did well last year. But past performance doesn't predict future results. Often last year's winners become next year's laggards. Stick to your allocation plan. Emotional decision making. When markets crash, everything in your brain screams to sell and stop the pain. When markets soar, greed tells you to go all in. These emotional reactions are the enemy of long-term wealth building. A diversified portfolio with a solid plan helps you stay the course, ignoring fees. High fees are a guaranteed drag on your returns. Over decades, the difference between paying 0.1% versus 1% in fees can amount to hundreds of thousands of dollars. Always pay attention to expense ratios. All right, let's bring it all together. Creating a diversified investment portfolio for maximum growth isn't about finding the next hot stock or timing the market perfectly. It is about building a solid foundation across multiple asset classes, aligning your allocation with your goals and timeline, keeping costs low, and staying disciplined through market ups and downs. Start with understanding the core asset classes: stocks for growth, bonds for stability, real estate and commodities for diversification, and cash for liquidity. Determine your allocation based on your time horizon, risk tolerance, and goals. Build your portfolio using low-cost index funds or ETFs. Rebalance periodically to maintain your target allocation, and avoid the common mistakes that trip up so many investors. If you do these things consistently over time, you'll be setting yourself up for long-term financial success. Investing isn't about getting rich quick. It is about building wealth steadily and letting compound growth work its magic over decades. Thanks so much for watching. If you found this helpful, please hit that like button and subscribe for more content on personal finance and investing. Drop any questions in the comments below, and I'll do my best to answer them. Until next time, take care and happy investing.